So today I want to talk about what happens in a down economy. Now, do I think these tariffs are going to throw us into a recession? I personally do not. But how infinite banking holds strong against other investments. So let me just ask a simple question to start off. When the economy tanks, do you want to hope your money survives or know it will? Now, I remember in 2008, people panicked. And I know one guy in particular that this hit really hard is he sold his business. And I think he got about $30 million after tax for this business. So heck of a business, right? He should have all the money that he would really need for the rest of his life. And he was in his late 50s at the time. And then what he did is the mistake he made is that he leveraged that 32 million, about 30 million of it he leveraged, right? He kept like 2 million in cash, but he had about $50 million in the marketplace or in Wall Street. And then because of this leverage. So when it went down to where he had nothing, right? He panicked, sold, and ended up with a couple $1 million of value after all of this. Sued his broker thinking he was going to recover this money. He lost that lawsuit. I was called in as an insurance expert, and I looked at, I don't know how many pages, hundreds of pages of notes and stuff and positioning. I couldn't find anything wrong that the guy did on the insurance policies. Now he sold the agent sold this business owner universal life. So it wasn't going to work long term in my opinion anyway, but he canceled the policies, everything else. It was a real mess. So, all right. In every downturn, there are three types of people, like the one I just talked about. One was who panic, right? He panicked. Those who pretend everything's fine, everything's good, it'll come back up. And then there are those who get rich. And the third, and this talk is about how to be in that third group using the infinite banking concept, what I call your financial unfair advantage, right? So the down economy exposes weak strategies. When an economy drops, here's what happens. The stock market plunges, real estate freezes, buyers vanish, banks stop lending, businesses either shut down or start hemorrhaging cash. Neither one good. Liquidity disappears, fear takes over, and people start making emotional decisions, right? So what are most people told to do by their financial advisor? Stay the course, buy the dip. Just hang in there, right? So let me give it to you straight. Those are hope-based strategies. Wall Street turns into a casino during a downturn. And if you're not the house, your money is locked in, tied up, and losing value. Now, yes, if you don't panic and you stay the course and everything, is the market going to come back? Well, it has. Does that mean it's going to in the future? No, it doesn't actually mean that, because the definition of an investment is the risk of losing all of your money, right? So that's what an investment is. IBC, infinite banking concept, in contrast, is your money doesn't disappear. You can access it when others can't. So there's no they can't tighten up the lending. You don't lose time. You don't lose sleep. You don't lose control. You still have all those three things. So let's kind of compare a little bit more detail. So I'm going to say Wall Street, stocks, 401ks, mutual funds, right? Anything that's based in Wall Street. We'll go pros, cons, and then we'll talk about it, or maybe a comment. Pros, it's easy, right? It's automatic. It feels passive. I'm giving this money to somebody that I think knows more about this than me, and they're taking care of it for me. Okay, so those are the pros. The cons are you have zero control, high taxes, no liquidity, especially if it's in a 401k, and massive volatility. In a downturn, your 401k becomes a 201k. You've heard that, and you're still penalized if you touch it. All right, so let's talk about real estate. Real estate, the pros are it's a tangible asset. It has cash flow. It has tax breaks. The cons are it's illiquid if you need cash most. If you need the cash the most, this is not the place to do it. Values drop. Tenants disappear. Financing tightens. So it's hard to expand during these downturns. In a downturn, the only people buying real estate are the ones who have liquid cash or access to capital, where we talking infinite banking maybe. That's not the average investor. It's the one who's structured their money in the right way using infinite banking. And there's other ways to do it, but infinite banking is an easy, simple, guaranteed growth way with just the guarantees inside the policy. Okay, buying businesses. The pros during a downtime is that you can get businesses cheaper. You have high cash flow, control, equity upside, right? The cons are, hopefully you're not investing in a business you don't know anything about, but it's risky if you do. It's complex and it's capital intensive, especially in a downturn. The right businesses are available at discounts, but again, only if you have access to cash on your terms. Okay, so let's talk about IBC and the unfair advantage, right? Here's why IBC is a secret weapon, and is one, liquidity, right? Liquidity. You can borrow against the policy anytime, no questions asked. So for anybody who has ever seen our video where we show how a bank works and what banks want, they want control, right? So with IBC, you don't have a bank. There are no credit checks. There's no permission. They want liquidity, right? Banks want control, liquidity, use, meaning using somebody else's time or money, other people's money, and they want to build equity with somebody else's money, okay? So IBC is a secret weapon because you have that liquidity, you have control, you have predictability, guaranteed, uninterrupted compounding, no market swings, no market swings. You don't have to worry about these up and down the economy affecting the market. Leverage, your money grows even while you borrow against it. Now think about that. Your money grows even while you borrow against it. Because you can collateralize that money and the insurance company has to give you their money, now you have other people's money. So where do you get other people's time? Well, you get other people's time by renting to them or having them as a customer, because they're going to go exchange time for money. So you're really buying their time so they can pay you rent. And then you have money making you money while you sleep. That sounds pretty good, right? Tax-free access, no capital gains, no income taxes. As long as you keep that policy in force to the very end, to the end of you graduating from this world, your death benefit will be passed on tax-free. You get use of the cash value tax-free. Your money grows tax-free. And when you borrow the insurance company's money, if you're using it for what we're talking about, like buying real estate and buying businesses, you actually get to deduct the interest that you're paying the insurance company. Okay, that's those 5 things: liquidity, control, predictability, leverage, and tax-free access. That's why it's an unfair advantage. And it's the perfect storm of predictability in a downturn. You buy the deals, you are the bank, and you help others while getting paid. And what I mean by helping others is if you're out there creating value and serving others in a business or in real estate, right? You're providing homes, whether it's mobile homes, luxury homes, storage, you're providing a service. You might be, obviously in storage, you're not providing a home, okay? But you win while others wait. They're supposed to stay the course. You're out there winning. And you know what you could do? If there's a huge correction and you think I'm going to get in the market, then use the infinite banking system and ride it up a little bit, pay back the loan, take the profit, buy an asset, and move on. So, here's the truth, is the rich don't park money, they position it. They don't park money, they position it. They buy assets, they're not the asset, okay? So I think back to the story that a lot of you have heard of me working for McIntyre Manufacturing when I was 13 years old. And I am working, it's a casket factory. So it's the, not the box that the body is in, but the hardware. So the fancy hardware and the metals and the handles, the biggest thing, well, not the biggest thing, but that's the thing that I had to deal with, is because you had to bend the handle around with a hammer, right? So I would use a hammer all day long. And I was sitting there working for, I'm sure, minimum wage, whatever that was. I think it was, I don't know, $3, $4, $5 an hour. And Dwayne McIntyre, he was the owner of the business. He wasn't working 8 hours a day. He wasn't swinging a hammer 8 hours a day. He was coming in for a few hours behind his desk. Again, at 13 years old, I don't know what he was doing. I kind of have a clue of what he would be doing now, but back then I didn't, right? And so I saw that he was the owner of the business. Okay. The business was the asset. I was an asset to him. I was producing income for him. I was a cash flowing asset. All the employees were. So you either own the asset or you are the asset, if that makes sense. So Wall Street wants your money, your trust, your patience, so that they can get paid no matter what. But with IBC, you take the banker's seat. Okay. Now think about this with Wall Street. Is you start putting money in there. Let's say you're 20 years old. We'll just make a round number. Now, I would be impressed if somebody at 20 years old was putting a lot of money in Wall Street, but it doesn't matter how much they're putting in there because they're going to lock that up for 40 years, right? Especially if it's in a 401k, because they can't touch it without penalty until 59 and a half. So we asked 3 questions about whether we should do that. It's not about qualified plans, these 3 questions. They're just 3 simple questions. Are taxes going up or down? There's this thing called math. Now, I was never very good in it, but I'm good at this, is taxes have to go up, and there's 4 reasons, or there's a few reasons. Is 1, Social Security, Medicare, Medicaid, and the 4th is the debt, right? The interest on the debt. Because of those 4 influences, taxes have to go up. It's just math. So that's the first question. Taxes are going up. That's the answer. Second question, the dollars that you have in your pocket, are they worth more today or in the future? Okay, well, let's use an example. When I was a kid, now I never buy candy bars, but the other day I bought a candy bar because I was just like, I wanted some sugar. Maybe my body needed some sugar. I don't know if it ever needs sugar, but I wanted some, the candy on that day. So I buy a Heath bar, $3.99. Now I had 1 bite of it and threw it away because I just wanted a little bit of sugar for some reason. So when I was a kid, I could buy 5 candy bars for $1. 5. And now $3.99, I thought it was like $2. But she rang it up as $3.99. But even if it's $2, that means a candy bar went from 20 cents to $2, $4. It's crazy. And I think they just take advantage of you. Downturns aren't scary. So the dollars in your pocket are always worth more today than in the future. So way back when I was a kid, right? Because of inflation, that 20-cent candy bar, 5 for $1, turned into a $2 candy bar, right? Now you might say, well, that's 50 years, Jim. Yeah, that's a long time, right? But that means that the dollars in your pocket are always going down in value. That means today you have good dollars in your pocket, and 10 years from now, 20 years from now, in my example of a 20-year-old, 40 years from now, it's going to be similar to that candy bar. That's crazy. All right, third question. And if you're not a farmer, you won't get this answer. No, I'm just kidding. I always say that this is a farming question because it kind of throws people off if you didn't grow up on a farm. But here's the question. It's really simple. Would you rather pay tax on the seed or on the harvest? The little amount or the big amount? Well, I would say I would rather pay tax on the seed. Any farmer in the world would say, I'll pay tax on the seed, not the harvest. But guess what? Qualified plans like IRAs, 401ks, all of them, they violate all 3 questions that you just answered, right? Is taxes are going up, but you're deferring the tax calculation to when you retire. Definition of retire, be taken out of service, right? So you're waiting to pay the tax. Now, what they would say back in the day, these financial planners, and I was one, thank God for God's grace, is they would say, you're going to be in a lower tax bracket when you retire. Is that the goal, to be in a lower tax bracket? That seems silly. Okay, so the next thing is that because of inflation, the dollars that are in your pocket, so you're putting in good dollars that have this value, and you're taking out dollars that have this value, whatever that gap is, right? In the example of the candy bar, it's huge. 5 for $1 versus at least $2. I paid $3.99. I don't think it was like a giant candy bar or anything, but I don't know. It was impulsive. So the third thing is you're going to pay tax on the harvest. But here's the great news. The government won't tell you what that rate is. So it's whatever they decide it is. So how do you plan for that? You can't. You hope that it's not too high, right? You hope that your money does great in the market. But let's say then you're going to start taking that money out. Sequence of returns. What if you have a downturn in your first year? What if it's right now? Right? We have this downturn in the market. Your workers are being killed off. If you spend that money it's not coming back. That money that you spend doesn't get a chance to recover, right? Anyway, nobody would ever do this if they understood all the consequences, all of the problems, everything else. So because downturns are wealth transfers, the only question is, are you going to be the one getting rich or the one getting squeezed? And don't ride the wave, be the damn ocean, right? Don't be at the mercy of the banks, be the bank. And I'm going to wrap this up with the story that I've, told a few times, but in his book, Letters to My Son by J.D. Rockefeller. J.D. Rockefeller is writing 38 letters. There's actually 2 bonus letters at the back of the book, so that we're going to say 40 letters, but it's called 38 Letters to My Son or something like that. He says, John or son or whatever, addressing his son, and the biggest hindrance to becoming the richest man in the world was the banks. But now I am the bank. So even back then, over 100 years ago, J.D. Rockefeller, the richest man in the world, understood the power of being your own banker. And Nelson then discovered that using an insurance contract that's designed the way that he recommends, the way that we do it, that was the best way to become your own banker and take over the banking function in your life. So your choices are really, you can ride the wave of Wall Street, and in a down market, don't panic, buy more if you have the risk tolerance to do that, if you have the guts to do that, because it's not guaranteed. You can lose everything, right? Buy businesses that are right, that are on sale, etc. Buy real estate that's right, that's on sale. But in all of those, when you're doing that, be your own banker, because somebody's going to be the banker in your life. It might as well be you. Have a great Monday. Remember, win Monday to win the week, and Godspeed. We'll see you next week.